Good morning, ladies and gentlemen. So, today for the weekend segment, I'm going to cover a small topic which a lot of people ask about, which is what moves the market? Why does it move? Why does price change? Does the spot follow the future, or does the future follow the spots, or do option prices follow the spot, or do they follow futures? So, a lot of questions in terms of how the entire thing works, and I'd like to address this.
Want to meet like minded traders and discuss option strategies, adjustments, and more? Just type in Discuss Nifty in your Telegram search box and join the friendly trader community.
So basically, how the market works is on two things fundamentally, and a third thing that I like to add, which is demand and supply. Everything works on demand and supply, as well as urgency. Is there urgency on the side of buyers, or is there urgency on the side of sellers? And how do the three different things, cash market, futures market, and options market, react? Is it one that moves the other? Yes and no. It's all that can move everything else. If there is cash buying in the market, relatively you can have the futures market and options market will react to it. If there are massive positions being built up in the options market or the futures market, the cash market will react to it. Now I'll go over how this works. So when I was talking about demand, supply, and urgency, right now, if you look at, for example, Reliance share, right? Reliance share is trading at more or less the last traded price. It keeps changing every second. 1939.05, right? So this is the price at which the cash market share is trading. A simple question: if I were to place a 10 lakh buy quantity of Reliance or 10 lakh sell quantity of Reliance, do you think the order would execute at this price? Absolutely not. If I'm placing such a large order, then I have some kind of urgency to buy 10 lakh shares of Reliance or 10 lakh shares of Reliance to sell. It's clearly an urgency, and 10 lakh is an exaggeration. But basically, if you look at the bid ask spread, right? So, what is this is called bid ask spread. These are the prices at which buying offers are being made, and for this much quantity. And these are the prices at which selling offers are made for this much quantity. Overall, here we're seeing there are 3.7 lakh buy orders placed and 6.3 lakh sell orders placed. One of the mistakes people make, if they think there are more buyers and then the stock is strong, if there are more sellers then the stock is weak, not at all true. Right now I can also place 1 lakh buy order at a price of lower circuit, let's say 1850, and it won't execute, but it will show up in the total here. And I can also place a sell order at 2000 for 1 lakh quantity, and it will show up here, but it won't execute. And I mean, all of that is slightly different, but basically, if I place an order for 10 lakhs, either on the buy or sell side, the price at which I will buy will not be this. If I place a buy order, my average will be something massive. It will be much higher, 10, 15, 20 points even higher than what is the current price, because I need to actually be able to execute the trade with a counterparty, and counterparties will only be available at higher levels. Okay, so let us say I did place that buy order. For whatever reason, I have purchased 10 lakh shares. I placed an order right now at market to purchase 10 lakh shares of Reliance. What will happen? The price of Reliance will rocket, because as I will absorb the entire liquidity of sellers, let us assume the price of Reliance goes from 1940 to 1960. What will be the reaction of the market? Immediately you will notice, let us say nothing else has happened, I have just moved the cash market. The futures market, let us say it does not react. What will happen? Future will be trading at 1945 and cash will be trading at 1960. That is a 15 points difference. And the market is not going to let that exist even for a second, because immediately there opens up an opportunity. You can then buy the future and sell shares in cash market, and that's giving you a 15-point profit. There is always a slight premium or a slight discount between futures and spot at different times. That is the different reason. I don't want to get into that at that point. But let us say somebody has moved the cash market so much, the futures market will immediately react to it because there is an opportunity. Think of it this way, and I'll draw it out to show you. For example, I'll have to do this with, okay, since I can't use cash insensible, I'll just explain it here. If there is a 15-point difference between the two, if you sell in the cash market at 1960 and buy in the futures market at 1945, 15 into 250, which is a good amount of return even after charges, is the profit that somebody will make. So there will be different algorithms, there will be different very, very fast supercomputers that will look at opportunities like that, which is why they will buy the future. And when they are buying the future and selling the cash market, you'll see that the future price goes up, right? I hope this makes sense. Now, what happens on the options side? Now, options side, I can explain with Sensible. Why does the call option go up? Because there is something called a synthetic future. Now, in any options, this thing, if you buy the call option, right? So here we are going to buy the let's say 1940. So buy the at the money call option and sell the at the money put option. This becomes something called a synthetic future. This acts as a future because obviously with the call option you have unlimited gain on the upside, and with the put option you have unlimited risk on the downside, and more or less this acts as a future. Now let us say somebody has purchased massively in the futures, right? And the future price has gone up to, once again, let us say 1960. So we're going to sell the May future at 1960 at 1960. Suddenly you notice that there's an opportunity here. There is a 7% return that somebody can generate by buying the synthetic future and selling the actual future. Do you think a market will let this exist? Market will not let this exist. An opportunity that is beating the risk-free rate of return will not be allowed to exist, because the moment there is a discrepancy between the options market, cash market and futures market, and after executing that trade and after charges, you are beating something called the risk-free rate of return. So generally you can assume between 5% 6% risk-free instruments can develop, right? They can generate. Okay, I refreshed the page, but you can go back to the page if you want to see. Whenever there's a discrepancy between the options, cash market and futures market, there are very, very high-tech algorithms that will plug in that change, that will immediately take advantage. The moment you're able to generate anything which is better than 5-6% from an annualized perspective, here is showing 7% on a monthly basis, immediately an algo will jump on it and take advantage of it. That is why, yes, the cash market moves the futures and options market. So does the options market move the entire futures and cash market, and so does the futures market. So if there are discrepancies, it will be plugged in because there's an opportunity to make money with those discrepancies. So similar thing would happen. Like, for example, let's say you look at the Reliance 1940 call option. Same concept is here also. Let us say I place a massive order. I want to buy 50,000 quantity. I place a market order at 1940 call option. The price of the call option goes up. So if the price of the call option goes up, suddenly there is once again arbitrage opportunity available between futures and the call option, between cash market and the call option. So all these things taken into consideration, the market fluctuates in a way that it does not matter. All instruments will move all other instruments, and it doesn't. You don't need to particularly look at one chart. People say, should I look at the futures chart? Should I look at the spot chart? It doesn't particularly matter too much. Futures gives you volume, so you can use a few other volume based indicators if you're an indicator type person, and yeah, spot doesn't give you that, but it really doesn't make a difference. And also, while trading options, sometimes especially if you're trading longer dated options, it's good to look at the futures, because whatever premium is reflected in the futures will also be reflected in the options. But if you're trading, for example, this weekly expiry and you're looking at month-end futures, then it will not make a lot of sense, because the futures premium will not be reflected completely in the options, because they are going to be settled against the spot. We don't know if the premium between the spot and the future is going to increase or decrease as this week goes. So because it's different expirations. So that's all. This is a small segment. Just wanted to cover demand, supply, urgency, and how one instrument will affect the other in terms of pricing. Thank you so much for watching. I hope this was useful to you. Have a great weekend.
Thank you for watching. Please post any questions you have in the comment section. Also, do not forget to like and share the video and subscribe to the channel. To find us on Twitter, Telegram and Facebook, use the username NiftyBN. Also, We post some of our trades to the community tab. So do not forget to check that from time to time.